Good morning. Let's take a look at another exercise in which we're going to deal with convertible bonds. So let's start with a quick screen share over here and read through the exercise. On January 1st, 2021, Madison Products issued a $40 million 6% 10-year convertible bond at a price of $40.8 million. Madison recently issued similar but non-convertible bonds at 99, that's 99% of face value. This is really extra information over here. The bonds pay interest on June 30th and December 31st. Each $1,000 bond is convertible into 30 shares of Madison's no par common stock. Madison records interest using the straight line method. So let's start with some basic information over here. Let's identify the life of the bond, that's N, the bond interest rate, and the market interest rate. The life of the bond is 10 years. The bond interest rate is 6%. The market interest rate is not given to us, and we really don't need it because we know the bond issue price, and they're telling us we're using the straight line method of amortization. I would need the market interest rate if I had to do calculate the bond issue price, or if I had to do the effective interest rate method. So that's not relevant right now, so I'm not going to worry about it. But I do need to look at this, the 10 and the 6. Interest is paid semi-annually. 10-year bond, if interest is paid semi-annually, it means interest is paid 2 times a year, a total of 20 times, and each time I will pay 3% interest. So the adjusted numbers are going to be 20, 3, and whatever the market rate is divided by 2. Again, I don't need that, but I just wrote that so that we are consistent. These are the adjusted numbers, and I need these adjusted numbers for calculations as I go along. So let's first start with the journal entry for the issuance of bonds. Fairly straightforward. I issued the bonds, so cash debit. I know I got 40.8 million. So I will write that down over here in the debit column. I'll leave a line and write bonds payable. Bonds payable is 40 million. So the difference that I have over here is the 800,000. And clearly that is the bond premium. I issued it at 800,000 in excess of the bond payable. So I asked for 40 million, I got 40.8 million. Okay, now let's continue to read the next part of the problem. On June 1st, 2023, Madison notified bondholders of its intent to call the bonds at face value plus 1% call premium on July 1st, 2023. So they're giving a 6-month notice. By June 30th, all bondholders have chosen to convert their bonds into shares as of the interest payment date. On June 30th, Madison paid the semi-annual interest and issued the requisite number of shares to the bondholders. So the company wanted to call the bonds, which means repay the bonds early, but all the bondholders, exactly 1 day before that call feature was going to be exercised, they all decided that we're going to convert to the stocks of the company. So we've been asked to do the journal entry at the issuance. We did that already. Then they've asked us to do the journal entry on June 30th, 2021 for the interest payment. So they're looking for the journal entry for the first interest payment. This is fairly simple. I will have bond interest expense debit. I'll leave a line and I'll write cash credit. I am paying 20 times, I will pay 3% of face value. So face value is 40 million. 3% of that is going to be $1.2 million. My bond interest expense, and then I need to amortize the premium, bond premium. Bond premium will be amortized. This 800,000 will be divided by 20. Allocation, amortization is nothing but the allocation, spreading the 800,000 over the life of the bonds. Bond premium is a credit balance. So to amortize it, I'm going to debit it, and that's going to be 40,000. So 800,000 divided by 20 will give me 40,000. The bond interest expense in this journal entry is a balancing figure, which is $1,160,000. Now this journal entry has to be repeated another 19 times, assuming nothing else happens, which it does. But it's going to be the same journal entry as we're using the straight line method. So whether you look at the first interest payment or the last interest payment, it's going to be the same. Now let's see what happens on June 30th, 2023. They're telling us we make the interest payment. Immediately after we make the interest payment, we have to issue the stocks and retire the bonds. So they want us to do the journal entry for both interest payment and the conversion. Journal for interest payment is very easy. It's identical to what I had before. So I'm just going to show you what those numbers are. Bond interest expense debit, bond premium debit, cash credit. It's going to be no different than what I had before. Okay. Now, let's get to the conversion. Now I'm converting the bonds, all of them. So bonds payable is going to be debit. I'm going to leave a line and write common stock credit. Bonds payable debit, I know the amount. It's $40 million. All of them are going to be, we are paying off all of it. Okay, as in we're not paying off, we are converting the debt security to equity security for from the viewpoint of the investors. So what I have over here now is a small calculation. This calculation relates to this bond premium. I have bond premium of $800,000. This was the entire bond premium that I had. Okay, I was amortizing it at the rate of $40,000 each time I paid interest. Okay, now the question is, by June 30th, 2023, how many times have I paid interest? I need to know how much has been amortized. I need the bond premium that's amortized. So $40,000 each time. So in 2021, I made 2 interest payments. 22, I made 2 interest payments. In 23, I made 1 interest payment. So it has been amortized 5 times. 40,000 times 5 is 200,000. Again, 2021, 2022, I had 2 and 2, 4 interest payments. And then in 23, I did 1 interest payment. So it's a total of 5 interest payments. So 5 times I've done the amortization. What I'm concerned with is the unamortized premium. That bond premium, I need to close that account because remember, that account exists only in relationship with the bonds payable. Since I'm closing the bonds payable account, I need to close bonds premium. Bonds payable was a credit balance, so I debited it in order to close it. Bond premium is credit, so I debit it in order to close the account. Since I'm using the book value method, this number is transferred into the common stock account, $40,600,000. That's a balancing figure in this journal entry. Now, just a quick note. If you were wondering how many shares we are going to issue, we have $40 million that we issued in bonds. The face value is $1,000 for each of them, which basically meant that I have 40,000 individual bonds. Each of these is going to convert. This is how many bonds I have. I'm sorry. This is how many bonds I have. They've said that each of these will convert into 30 common shares. Okay, so let me change the font color over here. So the number of shares I'm going to issue is going to be 40 million times 30. And this is the number of shares I have. So we have 40,000 bonds that I exchanged for 1.2 million shares. Since I'm using the book value method, other than just noting the number of shares that are issued, I'm not worried about anything else. If I was using the market value method, I need to know the market value of the shares on the date of issue, and I will have common stock credit at par value, and then paid in capital in excess of par would be the extra amount. But I don't have to worry about that. These are no par common stock, and I'm using the book value method. So it's very straightforward. Whatever I had in the bonds payable account, I transfer that amount into common stock. Once again, what you need to note is this unamortized premium or discount that's in your books, that account needs to be closed. That is very important for you to do this last journal entry of converting the bonds into stock. So this takes care of another exercise dealing with convertible bonds.